Welcome to Education Bench, your ultimate destination for mastering essential concepts in accounting and finance. Today, we're diving deep into a crucial topic that impacts every business: why GAAP is important. Picture this. You're an investor evaluating two companies. One adheres to standardized accounting rules, while the other doesn't. Which one inspires your trust? Today, we'll explore GAAP, generally accepted accounting principles, and reveal its significance for every stakeholder in the business world. By the end of this video, you'll not only understand what GAAP is, but also how it influences financial reporting, investor decisions, and the overall economy. So if you're ready to embark on this enlightening journey, make sure to subscribe for more insights that empower your financial literacy. What is GAAP? Let's start with the basics. What exactly is GAAP? In simple terms, GAAP is a set of accounting standards, principles, and procedures that companies in the United States are required to follow when compiling their financial statements. Think of GAAP as the universal language of financial reporting. These principles have developed over decades to ensure consistency and transparency in financial reporting. The Financial Accounting Standards Board, or FASB, is responsible for establishing and maintaining these standards. But why is this standardization critical? Imagine a world where every company had its own rules for accounting. Chaos would ensue. Without a uniform set of guidelines, financial statements would become a jumbled mess, making it nearly impossible for investors and analysts to make informed decisions. We need GAAP to maintain order in the financial landscape. At its core, GAAP serves three pivotal purposes: standardization, comparability, and transparency. Standardization. By adhering to GAAP, businesses create a consistent framework for financial reporting. This means that every dollar earned or spent is recorded similarly across different companies, allowing analysts to assess financial health without confusion. Comparability. Think about the challenges of comparing two companies in different sectors without a common accounting language. It would be nearly impossible. GAAP allows investors and analysts to make accurate comparisons between businesses, regardless of industry. This comparability extends beyond simple profit margins to more complex metrics like earnings per share and return on equity. Transparency. In a world filled with financial complexities, transparency is vital. GAAP enhances trust between companies and their stakeholders by ensuring that financial statements are presented clearly and honestly. This transparency fosters investor confidence, crucial for raising capital and ensuring business growth. Without these principles, the financial landscape would be chaotic, leaving investors and stakeholders in the dark. Transparency builds bridges. Without it, we risk losing trust. Key principles of GAAP. Now let's dive into some of the key principles that underpin GAAP. Accrual principle. This principle states that revenue and expenses should be recorded when they are incurred, not necessarily when cash is exchanged. Why is this significant? It gives a more accurate picture of a company's financial status. For instance, if a company makes a sale in December but doesn't receive payment until January, the revenue should still be recognized in December. Consistency principle. Companies must use the same accounting methods from one period to the next. This consistency is crucial for comparative analysis over time. If a company switches its method of inventory valuation from FIFO to LIFO, it could confuse investors trying to gauge its performance over multiple periods. Conservatism principle. This principle advises accountants to anticipate no profits, but to record all losses when there's uncertainty. Essentially, it promotes a cautious approach to financial reporting. This principle protects stakeholders by ensuring that companies do not overestimate their financial position, which can lead to poor investment decisions. Economic entity assumption. This principle states that transactions should be kept separate from the personal transactions of the owners. This distinction is vital for maintaining clear and accurate financial records. Going concern principle. It assumes that a company will continue to operate indefinitely, which affects how assets and liabilities are valued. If there's evidence to the contrary, financial statements must reflect this potential for liquidation. By following these principles, companies can provide a clearer, more reliable picture of their financial health, helping stakeholders make informed decisions. Benefits of following GAAP. So what's in it for the companies? Why should they invest time and resources in adhering to GAAP? Here are some compelling benefits. Investor confidence. When investors see that a company follows GAAP, they feel more secure in their investment choices. This confidence often leads to increased investment and higher stock prices, directly impacting a company's market value. Regulatory compliance. Adhering to GAAP helps companies comply with legal requirements, minimizing the risk of penalties and legal troubles. Companies that fail to meet these standards may face costly fines or reputational damage. Ease of audit. Financial audits become smoother when companies follow GAAP. Auditors appreciate a standardized approach, which simplifies their work and reduces the likelihood of errors. Companies that maintain clear records find that their audits are less stressful and more efficient. Consequences of not following GAAP. But what happens if a company chooses not to follow GAAP? The consequences can be dire. Legal repercussions. Companies that fail to comply with GAAP can face legal action, including hefty fines and penalties. Regulatory bodies scrutinize financial statements, and non-compliance can lead to serious legal ramifications. Financial misrepresentation. Non-compliance often leads to inaccuracies in financial statements, which can mislead investors and stakeholders. Such misrepresentation can lead to poor investment decisions and significant financial losses. Increased audit scrutiny. Companies not adhering to GAAP may find themselves under increased scrutiny during audits, damaging their reputation and trustworthiness. This scrutiny can lead to additional costs and time spent addressing auditor concerns. Loss of investor trust. When stakeholders perceive a lack of transparency or accountability, they may withdraw their support. This loss of trust can severely impact a company's market position and future growth prospects. Market exit. In extreme cases, failure to comply with GAAP can lead to bankruptcy or dissolution of the company. A lack of credible financial reporting can deter investors and lead to a loss of business opportunities. These consequences can have long-lasting effects on a company's credibility and overall performance. The stakes are high, and the price of non-compliance can be catastrophic. GAAP versus IFRS. Now let's briefly touch on the differences between GAAP and IFRS, International Financial Reporting Standards. While both sets of standards aim to improve financial reporting, they do have key differences. Principle-based versus rule-based. GAAP is considered rule-based, offering detailed rules for various scenarios, whereas IFRS is more principle-based, focusing on broader guidelines. This distinction can lead to differences in how financial transactions are reported. Inventory valuation. Under GAAP, companies can use the last-in, first-out (LIFO) method for inventory, which is not allowed under IFRS. This difference can impact a company's taxable income and cash flow. Reporting frequency. GAAP requires companies to report quarterly, while IFRS allows for annual reporting, adding flexibility for companies that may not require frequent updates. Development costs. GAAP requires that research and development costs be expensed as incurred, whereas IFRS allows some costs to be capitalized if certain criteria are met. Understanding these differences is crucial for international businesses or those considering expansion into markets governed by IFRS. As we wrap up today's discussion on the importance of GAAP, we hope you now recognize its vital role in promoting transparency, consistency, and accountability in financial reporting. Whether you're an investor, a business owner, or simply someone interested in the world of finance, understanding GAAP is essential for navigating the complexities of the financial landscape. If you found this video informative, please give it a thumbs up, share it with your network, and subscribe to Education Bench for more insightful content that empowers your financial journey. Remember, financial literacy is a powerful tool. The more you know, the better equipped you are to make informed decisions in the world of business and finance. Thank you for watching, and we look forward to seeing you in our next video.